Hello everyone, we're here to talk about government shutdowns. With the recent government shutdown recently coming to an end on Wednesday, we're going to look at it from a whole picture and what the markets typically do during these, and then what, more importantly, what they do after these government shutdowns end. So, just to start with, I think people understand this, but the government shutdown is really a result of the government not funding the legislation that's already in place. And so we see things like key data not being released. We see employees being furloughed. It causes a lot of disruption. But what does that actually mean for the stock market and, more importantly, people's retirement accounts and their investments? So if we look back since 1980, government shutdowns are actually pretty normal. We used to see them quite a bit, but they've always been short for the most part. Now recently, so in 95, there was a long one, 21 days with President Clinton based on some Medicare, education, environmental type things. 2013, there was a 16-day shutdown. 2018, there was a 35-day shutdown, and that had to do with border security. And then most recently, this one had a lot to do with healthcare funding, the one that started on October 1st going through November 12th. So if we look back at what happens, the S&P 500, which is the 500 largest companies in the U.S., it really, 1 month after, it's usually a little higher. 3 months after, it's a little bit higher after that. But 1 year after, it's often 10 to 15% higher. And part of the reason is during the actual shutdown, we see the markets get volatile, but they really go sideways. There's no direction up or down. And so we just see everything is kind of put on hold. It may look like it's, going down or may look like it's going up, but really the volatility evens out on average during these shutdowns. And so we see a period of really very little movement. And then we start to see the markets tick up after it's over. So if we look at a case study from 2018, 2019, now this, I will say, this is a little bit different because leading up to this shutdown, the markets actually did drop in fear of a shutdown, but during the actual shutdown itself, it rebounded. So this is a case where the markets dropped in anticipation of the shutdown. The shutdown comes, the market rallies, but then a year later after it was over, the market was 26% higher. So if we look at the most recent one, which started on October 1st, you're going to kind of see the same trends that we just went over on average. The markets kind of went sideways. Now they were a little bit up, so we were about 3.5% up. But after that, we see them jump up again right afterwards. So looking forward, typically we've seen the markets rebound after these shutdowns are over. If you're an investor, what should you do? There's really nothing new to do because of a shutdown. Trying to trade it's extremely difficult. So it's kind of back to the ABCs. Stick with your plan, keep diversified, keep doing the things you've always done. But it is interesting that we go through these periods with a lot of volatility, a lot of noise, and we usually come out better on the other side. So thanks for tuning in today. Appreciate your time.